Good evening, guys. It is Monday, March 31st, 2025. This Bathrobe business. I'm Georgi Oganov. I got the coffee and I got the business news. So let's jump into the stories. The first thing I'm going to cover is gold because gold is just continuing a meteoric rise. Let me show you guys the screen. 1 second. So gold is currently at 3173. So far, my predictions are coming true. I think gold is going to hit 3,500 before the end of the year, and I think it's going to hit 5,000 before the end of the decade. That may seem like a far number away, like, oh, it's the end of the decade. That's only 5 years away. Let's not forget, we're already halfway through this decade. You're just as close to the 2030s as you are to 2020. COVID was 5 years ago, believe it or not. So that number is much closer than you imagine. So I will continue being a proponent for gold. I think it's a fantastic investment. I've often talked about it on this channel, but really in the last couple of months, I think it's become completely obvious that it's the only secure investment that's out there right now. Now, I will actually amend that a little bit in this video. There are some bargains out there I am looking at. I'm going to mention them here as far as stocks, but I think gold without question is fantastic. Now, compare this to Bitcoin. So gold is continuing to rise. On the other hand, crypto is plummeting. So Bitcoin is still only at 83,000. And I know there's a lot of still crypto stands out there that will advocate for Bitcoin, Ethereum, and whatever other shitcoin they're trying to peddle. But you just can't compare these numbers. Instability and inflation, and people are flocking to gold. They're not flocking to Bitcoin. Next story. Let's talk about PCE data. So PCE data came out on Friday. There wasn't a video, obviously, on Friday. We just do Monday through Thursday. But PCE data came in, and people are saying that stagflation is on the horizon. Now, I'm not going to use that word. I think it's kind of a silly word. I'm just going to focus squarely on the numbers. So inflation ramped up again. So just for February alone, it rose 0.4%. This is a core measure of PCE. Increased from January by 2.8, and an annual core PCE is now at 3.6%. So we're back at an annual inflation rate of 3.6%. Now, a lot of people are going to blame tariffs. Again, most of the tariffs aren't even in place yet. We haven't really felt the effects of tariffs. And this article does a great job of underscoring the fact that this is the fourth month in a row that inflation has risen. The talk of tariffs is only about 2 months old. Actually, not even. No, I guess it is about 2 months old. Trump came to power January 20th. So this isn't just Trump's fault. Obviously, the tariffs aren't helping the situation. But as I've said from day one, this is a monetary issue. This has been caused by the Fed. It's exacerbated by the tariffs, but we haven't actually felt the effects of the tariffs yet. We're not going to feel that until Q2. Today actually marks the end of Q1. So this is all still monetary issues. We'll wait to see what happens in the next quarter. I think it's going to be really telling of what actually the tariffs do. I think it's actually going to be a little more underwhelming than people anticipate, but I think inflation is definitely going to be in the numbers from what the tariffs are promised to be. Now, they change on a daily basis. I've kind of stopped reporting on them except for the major one that came around last week about the cars. But I think that until we really see what's happening with those numbers, it's kind of silly to blame the tariffs for inflation because it changes on a daily basis and nothing's really been set in stone. Now, another thing I want to talk about is the JOLTS report. So technically, we're still dealing with the JOLTS report from January, which again is unchanged. It's before Trump came to power. It's before all the Doge cuts. It's before all the tariffs. But the January JOLTS report is actually pretty much unchanged. So JOLTS stands for Job Openings and Labor Turnover Survey. It's a great report that goes kind of above and beyond what regular job numbers do. Job numbers will tell you, if there's hires, if there's a strong job market, if there's a weak job market. This will measure how many openings there are for jobs, how many people left one job for another, what's the turnover rate, are there more businesses closing than opening. So it's a much more comprehensive report. I don't usually reference it, but one of the reasons I did was I was curious, with as tumultuous as the market is, what's actually happening with JOLTS. So in January, everything was unchanged. But tomorrow actually is the release of the JOLTS report for February. So by February, we already had a lot of these tariffs baked in and a lot of these layoffs baked in as well. So tomorrow I may change my tune. So far, it doesn't look catastrophic, but really the numbers will come out tomorrow, and this will be a good prequel of what we can see in Q2. Because what's going to happen with these jobs in February, if we're starting to see weakness already, it's going to continue. Now, if we're seeing strength, I don't think we're out of the woodwork yet, but I think it will show that the tariffs are much less impactful than people's perception of the tariffs. So we'll find that out tomorrow. Another interesting metric, this is following up on a story I talked about from last week, which is CoreWeave IPO. So if you'll remember, this is a company that kind of builds a lot of the infrastructure for AI on the back of NVIDIA. They do a lot of language model building, et cetera. This is really one of the first major I guess I should. No, it is. It's one of the first major AI companies that has IPO'd since this whole thing began, right? I mean, you can make the argument that Microsoft is an AI company, Google's an AI company, Meta's an AI company, and that's all very true, but all of those have already been on the market. This is the first time we're seeing just a raw AI company IPO, at least any one that I've heard of. And they're a major player in the industry. Well, originally, they changed the valuation from $45 to $57 a share to when they actually debuted at 40. They closed the day out at 39 and are currently only sitting at 37. In addition, they had some of the worst returns for the banks in the last almost 15 years. Now, that number doesn't really necessarily matter too much, but what's interesting here is from the moment that Facebook IPO'd, since then, there have been amazing returns on Wall Street. Every one of these companies, when they IPO, they have a major flood of cash. Their stock rockets to the moon. Banks get paid. Shareholders get paid. Good times are had by all. This is the first time that we're seeing in almost 15 years one of these companies have an opening that is subpar. But what's most interesting is it's an AI company. So it really does go to show what the sentiment with AI is, that the outlook is not great. So I think this really does go back to the fact that DeepSeek really helped burst this bubble, but this bubble was about to burst one way or another. DeepSeek kind of accelerated it. I think the AI, I don't want to even call it a bubble, but the AI boost that the economy was feeling has already come to fruition and it's gone. So it's very interesting what's going to happen in the next quarter, because now we're going to have to actually see what happens in a post-AI world in regards to what happens to market valuations when AI doesn't actually matter. Now, I do have kind of an answer to that. I want to share two more slides with you because, as I kind of said, there are a few bargains out there that I think are worth mentioning. So I talked to you guys about gold, but I think there's a couple companies out here that are worth purchasing into, and I actually did. So one of the companies I purchased into is my old friend, Bath and Body Works, because despite the fact of having strong earnings and a strong quarter, they were dragged down by the overall market. And so I bought it at $29 a share, and I'm holding it for right now. I'll probably sell it around the $35 a share mark, but we'll see where the stock is. I would say mid-April. That's kind of my timeline. But another interesting one is Google. So give me 1 second. I want to share this slide if my computer allows me to. It's really weird. It's fine with browsing history, but it's not great with sharing slides. Well, I guess I'll just tell you guys instead. No, it is letting me show it. So I picked up Google today at $155 a share, give or take. And it's near its 52-week low. But one of the reasons I picked up Google is because I think it's actually a bargain right now. And why I think it's a bargain is it's been dragged down very heavily by the AI drag. Now, at the same time, I think it's actually going to have pretty good earnings. For one, Google generally has pretty good earnings. So if it lets me share it, it does not want to let me share these files. So here it is. Google's has had fantastic returns for the last 2 years. They come in overestimate, last quarter being no difference. Now, a lot of people complain because their last quarter, they didn't exceed expectations with the same velocity they had in previous quarters. But remember, this was the AI boost. But one of the reasons I make an argument for Google actually doesn't have to do with AI. It actually has to do with Facebook. So with Meta, I apologize. So if you guys will remember, we talked about this last time. Um, Facebook had an outstanding quarter. In fact, they blew past expectations, uh, and they came in $1.25 above market estimates. Now, how they did that was very simple. They didn't obviously AI was part of their whole shtick. That was one of their components they invested, but it really had nothing to do with AI. It had nothing to do with the crypto or any new fancy development. All they did was sell more ads. That's all they did, and they reaped the benefits. They had a fantastic quarter. They sold more ads and they rocketed up above everybody else. So let's not forget, in the last session when everybody was reporting losses from Microsoft to Google to Nvidia, Meta was fantastic. Meta made money. Meta did exactly what these companies are supposed to do. They sold a product that people bought, and Google is doing the same. Now, how do I know that? Quite simply, I spend a lot of time on YouTube. YouTube is my go-to everything. It is my browser. It is my entertainment. It is my education. I spend hours on YouTube every single day. I have it streaming in one of my earbuds. I'm always listening to a podcast. I'm always listening to some kind of seminar. I'm always listening to business news. Everything for me is through YouTube. Now, why that's important? Because I spend so much time on YouTube, I know the trends. And what I've noticed in the last couple of weeks is the amount of advertisements that have appeared on YouTube. Now, ads have always been a component of YouTube sales, but nothing like what I've been seeing. Just today, before I started this video, I was listening to a video from Peter Zion. It was a 9-minute video. And there were, I'll tell you exactly how many commercials. One at the beginning, an ad at the beginning, 2 in the middle, and 1 at the end. So 4 in a 9-minute video. When I'm listening to a longer podcast like Rogan, there is an ad about every 6 minutes. This is at a frequency I have never seen before. So Google has just, all they have done is just copied Facebook's or Meta's playbook and said, hey, we need money. We can't just keep saying we're investing in AI. We have AI profits coming in, blah, blah, blah. The market has turned. So what they've done is gone back to the fundamentals and are selling ads. And if they're doing it on YouTube, they're doing it across all of their platforms. So I think this number that you're seeing here that Meta had last time, Google is going to have this time. And currently, Google is very much devalued. They are below their 50-day moving average. They are below their 13-day moving average, below their exponential moving average. By every metric, they are cheap. So I bought up a good amount of shares, and I think it's a great move. I think they're going to come back with a vengeance because they're not focusing on AI. They're focusing on fundamentals. Now, you can make the same argument for Facebook, but I don't think Facebook suffered the same drawback that Google had. Facebook's actually still a bit expensive. Now, its outlook may be better because I think they saw that it worked well. And I don't think they flooded the market on Facebook as heavily as they have on Google. So in other words, I think that Facebook still has more room to increase their ad revenue. But for me, it's not a bargain. It's more of a long-term investment. For me, I'm seeing Google as a trade, but Facebook potentially could do the same. So those are the 2 stocks that I bought. I bought Bath and Body Works for the reasons I've talked about. I've made a lot of money with Bath and Body Works over the last couple of months. I've talked about it in multiple videos. And Google, I think, is going to be another one that is going to come back with a strong reward. So that's pretty much it. Those are the stories of the day. I hope you guys have a fantastic Tuesday, and I will see you guys back here tomorrow.